Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Later in today's show, we're going to focus on Social Security, which is obviously a hotly debated topic in this election year. But before we get to that, I'd actually like to spend a little bit of time really reviewing what's going on in the market. Because while it seems like things are relatively lackluster, economic reports are slowing, etc., there's actually a lot to look at right now and a few things that I think are worth consideration. So very briefly, we've had a somewhat mixed week thus far. We had some positive ISM, which is the industrial manufacturing statistics. We had some positive information that came out there on Tuesday, followed by sort of mixed reports on employment and labor yesterday and today on Thursday. None of this information really seems to be moving the market too significantly, and that's mostly because a lot of the economic data has sort of been slowing, and also the market's not sure which way to go. We're waiting on a really key jobs report tomorrow, Friday, and there's also no new news coming from Europe. So in a nutshell, we're just continuing to trade somewhat sideways. But I'd like to look at two charts to highlight why this sideways trading is so important. The first chart that we're looking at here is a chart of the S&P. And this is just simply the month of April. And you can see how April's trading really is trending to sort of a point. And the concern here is, are we about to break out to the positive, or are we about to break out to the negative? Because as trading continues towards these points, this is really where volume starts to drop off, the market starts to slow, and a lot of the reason that this trading sideways is occurring is because of uncertainty. So, for example, on Tuesday we had really good news, and it drove the market significantly higher, but it still wound up closing in a somewhat midland range. On Wednesday, we had relatively bad news. It drove the market way down, but we still only closed down 10 points. And what a lot of traders and what a lot of technical analysts look at is just simply where the market closes, not so much what happens intraday. So it's interesting that we're seeing some big moves in the market day to day, but the market really seems to be closing relatively, in a midland territory. So what's happening here? Basically, the market's waiting for some kind of clarity on several factors, and there's three key factors that are really worth consideration. Number one, of course, is Europe, and most analysts feel that that information is already priced into the market. We know what's going to happen. We know that the ECB is willing to back Europe, et cetera, et cetera. So most analysts, most traders feel that the European situation is priced into the market. The second factor is the U.S. debt picture, and a lot of analysts feel that that is not yet priced in, but that's really starting to gain a little bit of momentum. You're starting to hear, more and more information sort of alluding to the U.S. debt picture, and of course that's happening as well because we're in an election year and that's going to be a focal point. But a lot of people feel that that particular situation, the size of the U.S. debt, the increasing debt picture that we have, the lackluster economy, that's going to have a negative impact on the market. And then, of course, you have the third factor, which is just geopolitical. I mean, what's happening in Iran, what's happening in Israel, and a lot of folks feel that that is also not being priced into the market at this point because it's relatively impossible to price that kind of risk into the market at this point. So these are three negative drivers that create a lot of concern for managers and also stunt hiring, stunt investment, and sort of keep that top range on the market. So if you consider that chart that we just showed, where we're watching that top range, where the top is on that range, that negative information is really what's creating that top and could create a cliff if we see some of that negative information come to fruition. You mix that with the election, the concern about the 2013 fiscal cliff, the Bush tax cuts sunsetting, new Obamacare taxes, etc., and it creates some concern. However, the other thing to consider is the bottom side of that range that we were just looking at, and is it possible that we could actually break out to the upside? And that's definitely a possibility as well. So you're sort of seeing this tug of war between the positive, which is the fact that corporations are lean and mean, they're in better financial shape than they were 5 years ago, 10 years ago, certainly back in 2008 when we fell off the financial cliff that we did then. So you're sort of seeing this tug of war between the positive, the fact that corporations are healthy, and if the economy starts to improve, we could really see a big boom in the market, and the negative, the fact that there's a lot of uncertainty out in the market. Managers are not sure yet whether or not they can start hiring, start investing. So we're going to see the market continue to trend sideways until we see some very clear economic data that points us in one direction or another. Another piece of information or another chart that I'd like to look at is one that I've looked at several times in the past on this show, and that's the chart of the 10-year Treasury. What you see here is a multi-year chart, and you can see that interest rates fell off a cliff starting in about 2009 and have continued to remain abnormally flat. This is just not a natural situation. As you can see over that multi-year chart, rates ebb and flow. That's not what's happening now, and the fact that the rates have remained so flat is really the result of Fed taking significant actions to keep these rates low, and they're now pledging to keep rates low through 2014. Typically what happens, as you see in the other portions of that chart, is that the market starts to drive rates up, or the economy starts to drive rates up. So, and either through a positive impetus or through a negative impetus, the market will drive rates up. That's not what's happening now. So what this chart is telling us, this 10-year Treasury chart is telling us, is that it's just another factor for why the market is sort of in wait-and-see territory. The market's not moving, interest rates aren't moving, so we're not seeing any changes in the bond market that are too indicative of economic factors, and we're not seeing too many changes in the stock market that are too indicative of economic factors. So really, right now, traders are sort of in wait-and-see mode, looking for some kind of key indicator to drive the market one way or another, and we're really just in a tug-of-war status, which is why intraday you might see the market move up 100 points, move down 100 points, but by and large it's sort of closing within a very set range. You'll also hear a lot of people saying, should we sell in May and stay away, sort of that old cliche, and it's been true in the last 2 years, or is this year going to be different? And they say, should we buy in May and pray? So this is the conflict that a lot of people are alluding to, is this tug of war that's going on mostly in economic factors. So that's pretty much what I wanted to discuss as far as what's going on in the market right now. It seems lackluster, but there's really a lot going on behind the scenes that bears consideration. So that's our market overview for today. We're going to discuss Social Security throughout the remainder of the show. So please bear with us. We'll be right back with the rest of Money Matters.
Hello, this is David Kroll. I'm from Mortgage Network, and this is Money Matters. The Mortgage Minute. The world is a complicated place, I've decided, and that's what I'm talking about this week. Last week I talked about the fact that the real estate market was getting traction, that we still had great deals, and that money's never been cheaper. So my basic message was, if not now, when? Well, in the past week, we've seen the financial numbers coming through a bit slow, and we've seen the realtors slowing down a little bit. It's a confusing time. You're going to hear a lot of contradictory information. Rates remain extremely low. The real estate available in the market remains incredibly inexpensive. Don't get confused. If you have a life plan or a life event that can be served by a purchase at this time, make your move. If you own a property and can benefit by the refinance, make your move now. Don't get confused. Thank you.
Welcome back to Money Matters. Throughout the remainder of the show, I'd like to discuss Social Security. I recently read an article in Investors Business Daily, and the headline read, "How Social Security Falls Short by 28% over the next 24 years." And I know we're dealing with statistics, and statistics can always be debated, especially during an election year and in light of the increasing U.S. debt loads. But the implications of this article and just Social Security in general are significant both to the investment markets and also, most importantly, to your personal financial plans. And I want to kind of discuss how those factors impact both of those markets, both the financial markets, and also your financial plan. So first, let's talk about a few facts, not statistics. The Social Security Trust Fund, which is valued at approximately $2.7 trillion, is split into two specific funds. One's for retirement benefits and one is for disability benefits. Technically, those two funds cannot be commingled. That's fact number one. Number two, both are funded by payroll taxes. Those are the taxes that you pay whether you're self-employed or you work for somebody else. Your employer pays a portion of it and you pay a portion of it. During the past 2 years, payroll taxes have been reduced by 2% for employees to provide some sort of relief in this difficult market that we have. They have not been reduced for employers, which is the big debate of if we're trying to drive employment, why don't we reduce payroll taxes for the employers as well? But that's a separate subject. So those are 3 facts that relate to Social Security as we see it right now. Pretty much all of the other aspects of Social Security, all the other statistics are up for debate. So starting with this, according to the Social Security trustees, Social Security is going to be fully funded through 2033, i.e. what they're trying to say is we're safe. No need to do anything, status quo is just fine. However, you have to look at the assumptions inside this report, and that's the thing about economics and finance, is you're relying on a lot of assumptions. And are these assumptions safe? That's sort of the art of both of those sciences. So they're assuming growth in revenues that don't actually appear likely given our current economic situation. For example, if we keep the current payroll tax rate where it is right now, which is something that is being considered going forward, only 72% of all benefits will be available in 2036. What does this mean? It means if you're 50 years old, you'll be 74 in 2036, and 28% of the benefits that you are expecting to receive will be cut. So in order to remain solvent then, Social Security would actually have to immediately cut 28% of their benefits, or they would have to increase payroll taxes by immediately another 4.4%. So what do we do here? So basically, let's start with the payroll tax argument. Because 50% of payroll taxes are paid by employers, and because we're at a relatively all-time high unemployment rate, an increase in payroll taxes immediately, which would probably stunt hiring by employers, is probably not likely. It's not a positive. It's probably not likely. It'd be very difficult in an election year to push something like that through. So the only other alternative that you actually have is cutting benefits. But again, who are you going to be cutting benefits for? Because certainly when you look at the current baby boom population and those that are currently receiving benefits, it's going to be very difficult to cut benefits for those individuals. They're currently receiving those benefits. It's what they've planned on for the past 20 years, 50 years, and that's what they're currently receiving. So it's going to be very difficult to make any changes there. Also, with U.S. debt the U.S. debt to GDP ratio at approximately 100% or slightly higher, some action is going to have to be taken. So if we can't cut benefits for the funds that are currently being paid, and we also for the benefits that are currently being paid, and we also can't raise payroll taxes, but we have a debt load that's increasing it to astronomical levels, what are we going to do so that we can avoid the same fate that Greece and Spain and Italy and all the other European nations have been facing with their austerity measures? Because that's effectively what these austerity measures are. It's delaying retirement, it's reducing retirement benefits, or at least that's a portion of it. So we're trying to avoid that fate, but we're going right down that same road with the program that we have at the moment. So before we step any further, let's think for a second about how the Social Security Fund works. The Social Security Fund itself, that $2.7 trillion, is actually a promise by the government to pay these benefits. So any deficits, any inability to pay, is going to be covered by bonds that the Treasury issues. So if the Treasury is issuing bonds to cover the Social Security nut, these bonds carry interest rates. Right now, these interest rates are really, really low. So you can kind of think about it as your mortgage. Right now, if you were to refinance your house, it's very easy to cover, or it should be relatively easy to cover those interest rates on the promise to pay on your actual debt. However, as those interest rates go up, it's going to be more and more difficult, more and more expensive to pay those benefits. So not only do we have the increased number of individuals who are going to be receiving benefits, but we also have the risk of interest rates increasing and therefore the cost of the program increasing year over year. So as a result, we expect, and again, we have a lot of assumptions, so I have to have a caveat in here that I don't mean to simplify too much, but as a result of this, we have a program that's expected to grow at least 50% faster than the rest of the economy. So for those currently receiving benefits, they're probably not going to experience any significant change, and for those that are likely to be receiving benefits soon, probably not going to experience any significant change. But for those who are halfway through their careers or younger, especially those in their 40s and 50s, they're going to start to see a real gap. For example, let's say, for example, that Social Security benefits have to be cut, which is the most likely scenario. And you're a 40-year-old in your mid-career, and you've made certain assumptions. You get your Social Security statement on a yearly basis, and you see that you're going to receive X dollars if you wait till full retirement age, Y dollars if you wait till you're 70, your spouse is going to receive Z dollars, etc. You make certain assumptions for your retirement planning. If you don't expect that you're going to have a 25% decline in Social Security benefits, which is what sort of the scenario is that we're looking at, if you don't anticipate that, then you're going to get to retirement and those Social Security benefits are going to be lower. If that happens, and if you wanted to cover that gap, then you would actually need to start saving 5% more right now, 5% more of your wages right now in order to cover that decline. Well, if you don't anticipate the 25% decline, if we're not honest about the fact that this program needs to be changed, and you're 40 years old, you're not going to start saving more because you're still paying for your kids' college, you're still paying your mortgage, and you're not going to be considering that gap that you're going to have to fill. So the question is, as the government and all the economists in the world are looking this over, is the government going to assume that workers are going to start saving on their own without the additional information about the fact that Social Security is going to have to probably reduce benefits for younger individuals, or will they mandate some kind of additional savings, or are they just going to do nothing and sit back? And the problem is that no one's actually discussing this savings gap. Obviously, there are a lot of problems with the Social Security system as it currently stands, but for working individuals in their 40s and 50s and younger right now, the problem is that nobody's really talking about the savings gap. If Social Security is reduced, how much do you need to save today in order to cover what that expected reduction is, instead of just sending you your Social Security statement with this pie-in-the-sky idea that when I retire, I'm going to get $3,000 a month, and there's going to be cost of living adjustments with it every single year. So we already see, as an additional problem, we already see that statistics indicate that savings rates are declining, especially for younger working individuals. Savings rates are declining. Also, a significant number of pre-retirees report that they don't feel that they've saved enough for retirement. So Social Security is going to be a hotly debated issue over this next coming year, and these are a lot of the factors that we're going to have to consider. So it's really important to consider the implications that reduced benefits will have on mid-career workers and their families, and also the savings gaps that they're going to face. So that's sort of the article that was recently read, along with a lot of other information on Social Security. And the next question is, for you as a viewer, how do you plan? And that's the question that we're going to answer in the second part of this show after this commercial break. We'll be right back. You're watching Money Matters. Welcome back to Money Matters. We've been discussing the challenges of the Social Security Trust Fund and the distinct possibility that benefits will be reduced, especially for individuals in their 40s, 50s, and younger. So how do you plan for these lowered benefits if you're in this group? Couple of words of advice here. First thing that you want to do is pull your Social Security statement, and you can get that from ssa.gov, or they send it to you on an annual basis. Review your benefits that you're expected to receive right now and those of your spouse. Consider any significant increase in benefits for waiting until full retirement age, or if you wait until 70. For example, if you wait until full retirement age as opposed to early retirement to receive your full retirement benefits, your increase is actually 8% per year. If you wait until you're 70, that increase is another 8% per year while you wait. So that's a significantly higher growth rate than you're going to receive through current interest rates right now. If you're close to full retirement age, you might want to consider waiting until 70 to claim those benefits because of that significant increase of 8% per year. However, the further you are from retirement, especially if you're in that 40 to 50 range, you probably want to consider that those benefits will be reduced and what that reduction might actually do to your overall benefits. So it complicates the question significantly, but it's really worth taking a look at what is my expected benefit, what's my spouse's expected benefit, and then I'd also look at what's the break-even analysis of these benefits, because I get the question all the time of, should I start taking benefits early, should I take them at full retirement age, or should I wait till I'm 70? And really this is a question of life expectancy. So how long do you think that you're going to live in retirement? Is the question is to determine whether or not when you should start taking benefits early or late. Because if you take benefits late and you live longer, you're actually going to receive cumulatively more benefits than if you take benefits early, and pass away earlier. So you really want to consider what's your family's life expectancy and when do you consider sort of the end of your plan is going to be. Next thing that you want to do is look at all possible sources of future income. Pensions, which of course are becoming fewer and fewer, especially for younger employees. Next thing is going to be 401ks, 403bs, and 457s. Understand those plans. Understand the benefits are available. 403bs and 457s, can often be structured as pensions, so understand how those work. Look at your annuities. What are the guarantees on your annuities for income? Life insurance, what are the options you have there for tax-free removal of the premiums? Any buyouts from the sales of corporations, sales of assets. These are all different things that you want to look at when you're looking to fund your retirement in the future. Next thing you want to do, develop a realistic budget for life during retirement. That budget's going to help you determine your number that you see on the ING commercials on TV all the time. And then lastly, you want to identify any gaps between these expenses and the income sources that you have and determine how you're going to fill those sources. So some of the ways people are filling them, sometimes people are working longer or working part-time. They might need to save more. Consider the power of compounding, for example. If you're saving more younger, you have the power of compounding on your side, you're going to have greater benefit when you're older. Cut back on expenses now, and cut back on expenses in retirement is another option. Also, you may need to be more aggressive in your investments, especially given the fact that we're in a very low interest rate environment. You might need to take on some more equities, perhaps higher dividend yielding equities in lieu of bonds. And you also might want to consider the timing of the sale of various assets based on your various tax brackets that you might be in. So obviously, we have lots of variables to consider, and I know that I'm talking very fast at this point, but the key point here is the further you are from retirement, the more likely changes in Social Security will impact you. You need to plan. You need to talk to your advisor. There's a lot of websites online that offer calculators and other information that can help you plan. And also, you need to really be aware and beware of anything that seems too good to be true. So, as you're looking into ways to fill these gaps in retirement, beware of false promises that can be out there. So that's sort of the how to plan, especially if you're in your 40s and 50s, if you're mid-career. These are steps that it seems like you wouldn't want to take until you're in that retirement red zone just a few years before retirement, but you need to take them now because a lot of the promises that have been made probably will not be able to be fulfilled in their current form in the future. So those are just a few thoughts on that. We'll be right back with our final parting shots from Money Matters. Please stick with us. Welcome back to Money Matters. One quick parting shot for the week, and that is number one, pull out your most recent Social Security statement or review your personal benefits and your break-even point on ssa.gov. Discuss this information with your financial advisor, with your spouse. Consider this and all sources of future income in your retirement cash flow plan and make a plan. So that's our final parting shot for the week. Look forward to seeing you next week. This has been Money Matters. I'm Emily Johnson. Thanks for joining us. Have a great week.